All right, let's talk about conditions. Let's talk about setups and stuff that you guys should avoid, right? Or if you want to trade, risk much less. Um, First things first, number one, no clear draw on liquidity. So what do I mean by that? It's pretty straightforward, right? If there is a pair you're trading that has no clear draw on liquidity, so we cannot come to the assumption of where price is most likely going to go, right? Here on Euro JPY, if we are trading this area, right, there is clearly no draw on liquidity, right? It's a very confusing pair and confusing price action where a lot of people lose money. If you're trading conditions like this, where you cannot come to a conclusion of where your drawn liquidity is, you will most likely take a lot of losses, right? If you avoid taking your losses, what happens? Your account stays green, you don't get pissed off, you don't FOMO into other trades, and all that, right? So avoid trades with no clear drawn liquidity. A pair that has a clear drawn liquidity, for example, is AUD CAD, right? So here, we can come to the assumption that this high will get ran. Why? Because we have swept weekly lows, right? Or even a monthly candle lows, right? So monthly swing low, we will trace to where? At least this candle, right? This candle is also your weekly idea, right? And price can obviously make its way to this fair value gap, right? As we come to that assumption and that conclusion, right? Those are our drawn liquidity, right? I'll make a video more in depth about drawn liquidity, but as we can see, we have a clear drawn liquidity and we have clear order flow to that drawn liquidity. Another low probability setup is when the market is decoupled. So what does that mean? We know DXY acts as an inverse to USD pairs, right? So if DXY is making higher highs, USD pairs, they're making lower lows. We can use this as our confluence, right? When they are coupled, right? So when they are, moving inverse, negatively correlated. However, when they stop being coupled, right? So maybe DXY is going higher and USD pairs are also going higher. For me, this is where I choose to step out, right? If these are decoupled, right, I'll completely avoid these, right? Because they do not fit my narrative. My narrative is if DXY goes higher, USD pairs like Euro USD will go lower, right? So now it's doing the opposite of my narrative, right? So it's much harder to find my bias, my conclusion, and my story, right? The third condition is avoid markets where you are 50-50. So this means when the market, if you can come to the conclusion where it's both bullish and bearish, avoid it. Say something like this, right? And then price hits its, higher time frame or something, and then from here, if you're still thinking price should be bullish, say from this demand zone or this fair value gap here or order block, whatever, right? If you're still assuming price will remain bullish, but you've also come to the conclusion that price could be bearish because we've reached a higher time frame POI, you will most likely get pissed off and lose your money. Why? Because if price goes higher, you're going to be frustrated that you reached your higher time frame POI and didn't get a reversal. And now, the next time when this happens, you're still going to look for longs. Right? Another reason you're going to be frustrated and why you should avoid markets where you're bullish and bearish is now you're going to be trying ping-ponging. If you are inexperienced, if you don't know how the markets really move, I do not recommend ping-ponging. If you are not profitable, I do not recommend ping-ponging. So ping-ponging is shorting from here, right? Maybe buy here and all that. Short. Sure, you can do that. right? Absolutely. But if you're not profitable, I would avoid doing all that, right? So if you come to the conclusion where you're both bullish and bearish, that is a market I tend to avoid. Why? Because I would rather catch the expansion in that bullish phase, right? Rather than risking my money on either shorting here and, still having a bullish bias because of, it might reach there and all that, right? So avoid markets that are 50-50 where you could come to the conclusion if they're bearish or bullish. Fourth one, avoid entering trades before NFP, CPI, and FOMC. Those three, usually the spreads are widened, right? So higher spreads, right? High spreads. The market condition prior is already going to be choppy, right? So what do I mean by that? So say you've got a setup, right? But FOMC, CPI, and NFP, what usually happens before these three news is the market doesn't really move how we want it, right? So by that you realize it kind of gets choppy. It does this a bit, you might get moves up, but it kind of ranges, right? Sure, you could trade them, whatever, right? But it's just risk management, right? The other news, you can absolutely trade. I love trading news, right? But these three, avoid it because one, your spreads are increased. So if you do take a loss, it's gonna hurt bad. Second, the markets are already choppy, right? So you could wait for news to, push price wherever you want it to go, right? Wherever you think it's gonna go, and then trade with your bias, and then you could enter whatever, right? But just be careful if you're trading those three. But news trading, it's not risky, but these three I would avoid just for those reasons, right? All right, number 5, avoid entering after a large expansion. As we trade, we want to get involved in the start of the expansion, right? So what do I mean by that is we know price, consolidates, accumulates, whatever, right? And then it starts rallying up, right? You start getting your breaker structure, your market structure shift, all that, right? You want to get involved as the expansion is happening, right? Learn more about open, high, and close. Learn more about your high time frame for this, right? But after the expansion has already occurred, the expansion will usually be with news or just some sort of volatility time, kill zones, this and that, right? But usually with news, there's no point of entering when the moves already happen. You can if the drawn liquidity is still much higher, but if we've reached a decent height, right? If we've reached decent amount of movement, there is no point entering after the expansion because now you're just chasing price, right? There is no reason for price to come down lower. So if you have caught this low, you are most likely in profit, right? And you will most likely not get stopped out. But as you enter here, right, you might get a change of character, whatever. Price still has a lot of room for it to come down, mitigate this and that, right? There's just no point catching or trading after the expansion, right? But you can wait for price to actually show you another expansion setup, right? Get involved here. Wait for time, right? Wait for volatility, right? So again, avoid entering after large expansion. Would rather get placed before the expansion and just ride that move like this. Here's a perfect example. We want to get involved here, not down here, right? So clearly this was a nice expansion lower, right? Possible entries here, which I've discussed in the Discord, which I have sent out as outlooks. But as the expansion's over, as we've reached the drawn liquidity, or as we get closer to the drawn liquidity, be careful if you enter, right? Always be careful about entering those areas, right? All right. The last one is when you're stuck between two PD arrays. So stuck between two PD arrays. So what this means is, say we have order flow bearish, right, fair value gap here. However, we now, in the same time frame, we now see bullish fair value gap, right? We are now stuck in two different premium and discount arrays, right? We should be bearish, right? However, price is not giving us the signs of being bearish, and it is disrespecting this fair value gap and creating its own fair value gap. All right, so now, do you take the buy from this bullish fair value gap, or do you take the sell from this bearish fair value gap? Right? If you do not have a clear higher time frame narrative, if you do not have a story, it's very easy to trade, right, and actually get chopped up in these markets, right? If you know your draw is lower, so if you know your draw is lower, you can obviously take shorts lower, right? Again, this comes back to the no clear draw on liquidity, right? 50-50 bias. Everything should be linking up. Everything should be making sense, right? So now, if you don't have a clear draw on liquidity, don't trade, right? If you don't have a clear draw on liquidity, don't trade. If you have a 50-50 bias, so now, you might be bullish, you might be bearish, don't trade. Simple as that. You could wait for the moves to happen. You could wait for this high to get swept, then come down lower. That's fine, right? If your draw is here. If you've reached your draw on liquidity and now we're stuck in this here, I would avoid it, right? I would avoid that, right? And I would just wait for, if price wants to go bullish, I'll get involved, right? I'll get involved. That's fine. There's no point of risking my capital here.